Welcome to vTalkInsight, Allocator's Lens Daily for March 5th, 2026. Cross-asset positioning is being pulled between an energy shock in the Middle East, sticky inflation signals, and surprisingly resilient growth. That mix is forcing allocators to reassess how much risk they want in equities, how patient central banks could be on rate cuts, and where to find genuine diversification. In equities, the picture is one of resilience at the index level, but sharp rotation and regional stress beneath the surface. U.S. stocks have snapped back, with the S&P 500 and NASDAQ posting gains close to 1% and volatility gauges easing from recent highs, even as headlines from the Middle East remain intense. Strong economic data and solid payroll growth in areas like construction and healthcare are underpinning that risk appetite. At the same time, parts of Asia are experiencing a very different regime. South Korea's Kospi has just endured a record two-day drawdown of almost 20%, erasing much of its earlier artificial intelligence-driven rally and pointing to forced deleveraging in regional tech. Leadership within equities has clearly rotated away from a narrow group of mega-cap technology names toward a broader set of sectors and regions. Flows are moving from expensive U.S. growth and concentrated tech exposure toward value, small caps, and international developed and emerging markets, where performance has been helped by better earnings, fiscal support, and exposure to infrastructure and commodities. Sector-wise, industrials, materials, and consumer staples have posted strong year-to-date gains, while portfolio managers are gravitating toward healthcare, technology tied to artificial intelligence infrastructure, materials, and energy as core themes. Real asset equities in energy, metals, and commodity producers are also being used as hedges against inflation and supply shocks. Artificial intelligence continues to anchor the secular growth narrative, even as higher rates and energy costs weigh on valuations. Major cloud platforms are committing to substantial data center capital spending. Broadcom has guided revenue well above consensus and launched a large buyback on the back of booming custom AI chip demand, and NVIDIA's outlook remains supportive for memory and semiconductor names despite recent volatility in Korean equities. Yet the macro backdrop is less forgiving. Persistent inflation risks and the possibility of higher for longer policy rates are creating valuation tension, especially for long-duration growth stocks. An oil-driven inflation surprise is seen as one of the main macro threats, with a potential for a scenario where both equities and bonds correct together, reducing diversification. For equity allocators, that puts the focus on dispersion between regions like the U.S. and Asia, between real asset beneficiaries and energy-sensitive consumers, and between AI winners and businesses lacking clear exposure to these structural trends. Turning to rates, the dominant theme is a repricing away from early and aggressive easing toward a more patient stance, shaped by energy and inflation dynamics. Federal Reserve officials have been leaning hawkish, signaling little urgency to cut, while core personal consumption expenditures inflation hovers around 3%, notably above core consumer price inflation closer to the mid-twos. Recent spikes in gasoline prices and concerns over Middle East supply risks are reinforcing the case for caution, prompting some policymakers who had argued for early cuts to pivot toward a wait-and-see posture. At the same time, the resilience of U.S. growth is feeding debate that the neutral rate may be higher than previously assumed, which would limit how far and how fast policy can ultimately be eased. Outside the U.S., bond markets are also wrestling with the inflation channel of the energy shock. European yields have pushed higher as traders price the risk that the European Central Bank could tighten further and as expectations for Bank of England rate cuts fade, amid concern that official inflation projections may be too optimistic given volatile energy costs. In emerging markets, central banks in countries such as India and Indonesia have already intervened to stabilize currencies pressured by higher oil and a stronger dollar. One key cross-asset concern is that a larger oil shock could drive a period where both equities and longer-duration bonds sell off together, eroding the traditional diversification benefit of sovereign debt. In that context, money market funds and short to intermediate maturity high-quality corporate bonds are acting as the primary safe havens inside fixed income. Credit is where the underlying strain in this higher rate, higher energy world is becoming most visible, especially away from the public indices. On the surface, investment-grade spreads have only drifted wider from generational lows, and default rates are merely normalizing back toward the 3.5% to 4% range seen in past cycles rather than signaling systemic distress. But tightening financial conditions, an energy shock, and increased macro uncertainty are making many allocators reluctant to extend credit exposure aggressively, particularly in longer duration or lower quality segments. Even so, institutional appetite for private capital broadly remains intact, with pensions and other large investors expected to maintain or even build allocations over time, provided manager selection and risk controls are robust. Beneath that aggregate picture, private credit is going through a more acute and messy adjustment. Rapid growth from roughly $300 billion to around $2 trillion has come with looser lending standards and heavy sector concentration, especially in software, which represents only about 1% of U.S. companies, but close to a quarter of direct lending exposure. Many of those loans were originated in 2021 and 2022 at elevated valuations and high leverage, leaving borrowers exposed as refinancing costs rise. Recent developments highlight the strain. Large flagship funds have seen record redemption requests. Some publicly traded business development companies have marked portfolios down, and managers have been selling their best-performing loans to raise liquidity, leaving remaining books skewed toward higher-risk assets. The consensus within the industry is that this shakeout is likely to be drawn out rather than a short, sharp reset. Managers expect future software lending to come with lower leverage, higher spreads, and tighter covenants as they demand more compensation for risk. At the same time, there is a clear tilt toward hard asset-backed deals in areas like aircraft, maritime assets, and industrial equipment, where recovery values are more tangible. Large, diversified platforms with strong workout and restructuring capabilities are seen as better placed to navigate rising dispersion, while more concentrated middle-market players carry greater downside risk. For multi-asset allocators, the key watch points are redemption and gating decisions in private vehicles, the evolution of default and recovery data in software-heavy books, and any spillover into bank balance sheets or public credit markets. In foreign exchange, the U.S. dollar has reasserted itself as the core safe haven, helped by both geopolitical tension and the terms of trade shock from higher energy prices. The greenback is benefiting at the expense of currencies from major oil importers, including the yen, while producers such as the Canadian dollar are showing relative resilience. Emerging market currencies are under pressure, prompting central banks in countries like Indonesia and India to step in to support their exchange rates as higher oil feeds inflation concerns. Near term, this dollar strength reduces the perceived benefit of diversifying away from U.S. assets and adds another tightening channel for global financial conditions. Safe haven demand is also visible in gold and, increasingly, in digital assets. Gold continues to attract notable inflows from both retail investors and central banks seeking protection against inflation and macro uncertainty, even though stronger dollar dynamics and fading momentum trades introduce the risk of near-term pullbacks. Crypto, particularly Bitcoin, is playing a more complex dual role. Spot Bitcoin exchange-traded funds have seen substantial inflows, and recent price action shows periods of both high beta risk on behavior and partial safe haven characteristics, with episodes of anti-correlation to equities as investors rotate away from overbought stocks. Regulatory developments, such as a Federal Reserve master account for a major crypto platform and discussion of tax exemptions on small transactions, underscore a gradual integration of digital assets into the traditional financial system. Commodities, and oil in particular, sit at the center of the current cross-asset story. Persistent missile and drone incidents, shipping disruptions, and fears around the Strait of Hormuz have driven Brent crude up more than 40% from recent lows to the mid-80s, with estimates that almost $20 of that price reflects a war risk premium. Market participants see a highly binary set of paths. A short-lived disruption could allow prices to settle back, consistent with relatively modest moves in longer-dated contracts. But a prolonged conflict or closure of key shipping lanes could threaten up to 20 million barrels per day of flows and push Brent toward triple-digit levels in the $100 to $120 range. There are, however, important buffers that currently separate higher prices from a full-blown supply crisis. Global crude markets remain well-supplied, with record production from the U.S. and other regions, significant inventories, and spare capacity in producers like Saudi Arabia and the United Arab Emirates. even if pipeline bottlenecks limit how quickly the capacity can be rerouted around any choke points. Strategic petroleum reserves in the U.S., Europe, and China also provide a cushion, and excess North American supply is running several million barrels per day above demand, which could exert downward pressure on prices later in the year if the geopolitical situation stabilizes. In the nearer term, though, European natural gas prices have surged around 75% since the conflict escalated, and retail fuel prices in places like the UK and US have already jumped, creating a clear pipeline for higher headline inflation in the coming months. Beyond hydrocarbons, the commodity complex reflects both inflation hedging and longer-term structural shifts. Real asset equities tied to energy, metals, and broader commodity production are being used as portfolio hedges against the risk that an energy-driven inflation shock undermines both growth-sensitive assets and traditional bond hedges. Demand for critical minerals such as copper and gold is supported not only by industrial needs and electrification, but also by national security priorities and efforts to rewire supply chains, with governments accelerating permitting and regulatory reform for new mining projects. Meanwhile, the surge in electricity demand from artificial intelligence data centers is creating tangible opportunities in renewables and grid infrastructure, even as policymakers in some regions intervene to cap consumer energy costs. For allocators, the key variables to monitor are the physical integrity of Middle East infrastructure, the durability of current price spikes, and whether implied volatility in oil and gas remains elevated or starts to mean revert. Across the major asset classes, today's picture is one of resilience overlaid with significant tail risks rather than an outright regime shift. Equities are digesting the energy shock through rotation rather than collapse, with U.S. indices supported by solid growth and artificial intelligence themes, even as parts of Asia endure severe drawdowns. Rates markets are slowly conceding that easy cuts may be slower and shallower, particularly if energy keeps headline inflation elevated, while credit is quietly absorbing the strain of higher funding costs, most acutely in private markets with liquidity and sector concentration issues. In currencies and alternative stores of value, a firm dollar, ongoing demand for gold, and renewed inflows into crypto all reflect the search for safety and optionality in an uncertain geopolitical environment. Commodities tie the story together, with oil and gas pricing the balance between ample current supply and extreme downside and upside scenarios for Middle East disruptions. The coming days will turn on whether the conflict path, inflation data, and central bank rhetoric reinforce this uneasy equilibrium or force a sharper cross-asset repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.